Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, March 3rd, 2025. Well, last week we most definitely had a lot of volatility in the market, a lot of news that hit, and a lot of economic data. So hard to make out exactly what is going on and where the economy is heading, but we'll hit the data points, show you what happened in the markets, and then talk about what we expect to see in economic data this week. So last week started off innocuously. Wednesday, new home sales came in below expectations. That doesn't generally move the market. Came in at 657,000. Expected 680, not any big deal. The next day, though, things did change a little bit. So durable good orders ex transportation, actually pretty good. Durable good order, the headline number, much stronger than expected. Expected to be up 2% month over month, came in at 3.1%. If you strip out transportation, it was expected to be up slightly, 0.3, came in flat. So net between those two, slight positive. However, then a big number that shocked people a little bit, initial jobless claims, which the weekly numbers have been running as low as 205, 210, up to 220, 225. That has been the range really over the last year. Expectations were 221,000, but it came in at 242,000. Now, given what is occurring in Washington and Doge, I'm not all that surprised by it. It did seem to surprise investors as expectations, again, were for only 221. So that number is probably going to remain elevated, and we'll see what that number is expected to look like for this week. So Friday was the big day in terms of economic activity. We had inflation, personal income, personal spending. So we had PCE, core PCE. Inflation-wise, came in exactly as expected. Both core PCE and the headline PCE numbers came in exactly as expected. Month over month, the January number was up 0.3%. Actual 0.3, consensus expectations 0.3. So no news there. But personal income, this was a bit stunning, was expected to come in month over month, positive 0.3%, much better than expected, positive 0.9. Now, personal income is not just wages. It is also personal income from interest and dividends on stocks. That was actually one of the big drivers to the beat was personal income side was dividends and interest consumers received, individuals received. So that was a huge beat. And then on the other side, personal spending month over month was expected to come in at a positive 0.1% for January, came in at negative 0.2%. Now, that's well below expectations, but we are not that surprised by it. We had the retail sales number that came out just 3 weeks ago that was significantly lower than expected. If I remember correctly, it was a negative 0.9 when it was expected to be up nearly 0.5%. So personal spending down, personal income up. That's good for the savings rate, not good for potential GDP. And we're going to see that right now. This is one of the more stunning charts I have shared with you over the last 2 years that we've been doing this. Atlanta Federal Reserve, we always look to them for their insight, their expectations for GDP growth during any given quarter. So they'll have revisions roughly every week, sometimes more than once a week, but it's usually 10, 20, 30, maybe even 40 basis points. This is stunning. A week ago, they were calling for a positive 2.3% GDP growth in the first quarter, 2025. They revised that down to a negative 1.5, so a 3.8% swing in 1 week. I haven't seen that. I haven't been watching it forever, but that is a stunning reversal. So we'll see if they're correct. Inflation expectations went down modestly last week. It was 4 basis points. So the 10-year expected average inflation rate, 2.38%. Fed funds future. Now, this moved a little bit. So the odds of no cuts basically not going to happen here for the March meeting, March 18th, 19th, I believe. But then the expectation by the end of the year for at least 2 cuts, that definitely moved up last week. It had been 66% the prior week. That moved up to 81% as of the end of the day Friday. So with all that economic activity that was released last week, the puts and takes from it, how did the market respond? Negative to equities, very positive for fixed income. So equities, S&P 500 last week down almost 1%, negative 0.95%. The real driver under that, growth. So definitely growth stocks. They are rolling over. They were the big winner last year. We've talked quite a bit about the Magnificent Seven. That whole group is pretty much rolled over at this point. Growth last week down 2.25%, value up 1.2%. I think that's pretty significant. So with S&P 500 down 0.9%, developed markets ex-US about the same, a little bit better, minus 0.77. But what had held up really well year to date and rolled over last week, emerging markets. Emerging markets last week down, it was negative 0.44%, and that was all mostly driven by China, down about the same amount. So I mentioned fixed income, very positive. Boy, quite a rally. The 2-year yield dropped 20 basis points last week. The 10-year dropped 21 basis points. So the Bloomberg U.S. Aggregate Bond Index had an amazing week for bonds, up 1.26%. And on a year-to-date basis, that index is up 2.74%. So let's take a look at the economic activity, the data points expected that will be released this week, and expectations. So Wednesday, ISM services. Manufacturing, ISM manufacturing has actually been rebounding, moving up. The last 2 years have been horrible. Actually, you could say 4 years, not good. But the manufacturing number has been moving up. Conversely, services number kind of coming down, had been sticking pretty close, 54 to 56. The expectation is it is going to be coming in at 52.9 for the month of February, roughly in line with what we saw for the month of January. Now, I mentioned initial jobless claims. This is pretty impressive. The expectation now for this week, we're going to see 340,000 claims. Remember, just a week ago, the expectation for the prior week was 225,000. So expectation, 340,000. And again, last week was upside, which is negative surprise, of 242,000. Friday is the big day in terms of economic activity that's going to be released, almost always is. Non-farm payroll, this is going to be fascinating. So we've just showed you the unemployment number last week, much higher than expected. The expectations, another tough week in terms of initial claims. However, non-farm payrolls actually expected to be up for the month of February. Month of January came in at 143,000 new jobs. The expectation, consensus, is 153,000 for the month of February. If that happens, unemployment rate is expected to be static, 4% year over year. Average hourly earnings, that's expected to drop from the January level that was up 0.5% month over month. That's expected to drop to 0.3%. And average hourly earnings, static as well, expected to be 4.1% year over year, same as we saw at the end of January. So that's it for our economic recap. Thank you very much for attending. We'll look forward to seeing you next week. Thank you very much.